Hey, it's Jim, and this is FRM Part II, topic on market risk measurement and management, and the chapter on validating value at risk models. Let me just remind you that the previous handful of chapters, we talked about profits and loss, we talked about value at risk and expected shortfall and extreme values. We looked at a bunch of different ways to do all that. Then we did some back testing and some mapping, talked about stress testing and the importance of benchmarking. Well, what it's time for us to do now is to take all of the hard work that we've done and apply them to what the U.S. banking agencies are recommending in terms of guidance, and then maybe even more importantly, what the Basel Committee on Banking Supervision has to say about all this. So that's the term validating inside of this chapter title. Just for learning objectives, let me go ahead and summarize those here in this introductory slide. Of course, what's the idea behind this validation? And so there are three keywords up at the top: reliability, accuracy, and applicability. Of course, we're measuring this market risk. And let me just go back here real quickly. Of course, we're validating for market risk. And remember, market risk means a lot of things. Now, what the U.S. banking agencies have come up with is that there are essentially three kind of elements to value at risk model validation. The first one is conceptual soundness. We'll talk about that at length here in just a minute. The second one is to come up with some kind of an idea of outcomes assessment or sensitivity, and that can include sensitivity analysis and the confidence intervals and then benchmarking at the end. One of the interesting things about this author, who is one guy who's from the Fed, by the way. He at the end of this chapter, he talks about confidence intervals and benchmarking, and he makes the comment that he's not quite sure why, but it appears as if banks and bank holding companies don't use confidence intervals much. So he's kind of suggesting that they do. And then he even terms benchmarking as clearly the most neglected part of value at risk and all this stuff that we've been doing. I only mention that just because since the author seems to think that this, and he would know, that these two areas have been ignored. Maybe they're good. Maybe they're good exam questions. That's just me guessing there. All right, so let's talk about this idea of conceptual soundness. And note at the end of the learning objective, this is during the validation process. So the first thing that we need to do is go back and remind ourselves of all the different ways that you can compute value at risk and even expected value and extreme values and some of those other things that we've discussed in these previous chapters. Talk about these assumptions. What kind of things do we believe the market exists? Do we think about efficiency? Do we think about normal distributions? Do we have to worry about kurtosis? How do we estimate standard deviation? Do we like the Garch model? Do we like some other kind of a model? So the assumptions are critical that they're based in sound and fundamental economic and financial theory. And then what do we do about the data? Clearly, bank holding companies are going to have access to data. Does it go back to the beginning of time? Probably not. Do we need to worry about it going back to the beginning of time? Probably not, although it would be interesting to see what would have happened if we had these kinds of risk factors and exposures right before the 1929 crash, at least for equities or fixed income securities. So the data is probably going to be fairly accurate and fairly complete in the recent history for many, but not all of our exposures. So you need to worry about the accuracy of the data. That's the key thing: accuracy and completeness. And then the methodologies. This is what I was referring to about the different ways that we compute value at risk. And of course, the methodology is based on the assumptions that we make at the beginning. So look down at the bottom. Remember in that very first chapter inside of this topic, we talked about profits and loss. And those models, those value at risk models that are based on P&L, oftentimes they don't capture the dynamic risks, especially those that are associated with position changes and risk factor changes. So those are good ways to start, but then we need to go ahead and add something to it. Now, what about this idea of data? We can have an actual history where we can go back and look at exact positions, exact asset allocations, and then exact profits and loss on a daily basis or maybe a weekly basis. From my perspective, I always think about these models, and this, of course, is some guidance from the Basel Committee. I think of the best way to do this is over a 10-day period. Although I'm not discounting the one day value at risk, because that's important. But 10 days sounds to me like it's super reasonable. So we can show that profit and loss over the previous 10 days, but that's known as a static position. What did we do? What did we do? What did we do? That's why this concept of pseudo-history is super important for this concept of soundness. And so let me tell you a little bit about this pseudo-history. What we do is we take the current risk exposures and the current risk factors in our portfolio, whether it's bonds or equities or some kind of derivatives or combination of all of those. And we go back and say something like, if we would have had this exact portfolio, if we would have had this 10 days ago, what would have happened over the next 10 days? So you can get the sense that we can begin to see exactly how things change from day -10 to -9 to -8, etc. Now, the cool thing about this, and by the way, a lot of people call this historical simulation. So what we would do is we can go back and just look at the profit and loss over that 10 days. And that's an important starting point. But what we do then is we go from day -10 to day -9 and see how that portfolio would have performed over that day. And then we could make adjustments, right? So there's reflecting position changes over time. So this is dynamic. So remember actual history statics, remember pseudo-history dynamics, and we can do this over that 10-day period, and we can use sensitivity analysis, which we'll do here in just a little bit in more detail, but you can see how using this pseudo-history is going to give us historical simulation. It's going to give us, let me start that over. If we have actual history, this is the data. But if we do pseudo-history, we have this much data and this much data. Can you guys see my arms going? So what this does is give us a much more complete data set, which allows us to determine what were our successes, what were our failures, what could be our hypothetical failures and successes. We're just going to call those profits and losses. And so this is really cool stuff. And this is why, the U.S. agencies and Basel and anybody else out there who's keeping track of this kind of stuff says, pseudo-history, this adds a lot of value to our understanding. Now, the important thing, the super important thing, and from my perspective, this sounds like an even better exam question is, why do we do this? And the answer is, well, then it helps us for day +1 and day +5 and day all the way out to +10. So if we're using a 10-day window historically, then we probably want to use a 10-day window going forward for estimates and forecasts. Let's take a look at just a quick example here. Suppose that we have tons and tons of deep out-of-the-money puts. So what's happening is that or generating income, right? If we're writing these put options. So go back over the last 10 days. So what is the chance that a deep out of the money put option is going to turn into the money? Well, the only way that can happen is if we have some kind of a crash. Whatever those underlying assets are, probably shares of stock, but it could be almost anything. So remember that selling these deep out of the money puts means that there's a super low probability that these things are ever going to be exercised. So we can be tempted we could be tempted, mind you, go back to the 2007 and 2008 and 2009 financial crisis, where those people who were writing those credit default swaps were just thinking, oh my gosh, this is easy money. This is easy money. I got bunches of people out there sending me their hard-earned money every quarter, and all I'm doing is holding it because none of these bonds are ever going to default. The same thing here with the put options. So if you use that profit and loss model that we did way back in chapter 1, probably we're going to estimate the risk, and of course, just keeping that value at risk in the left tail, we're going to underestimate that value at risk. Now, this is what I was talking about just a moment ago in regards to that pseudo-history, that if we change our exposures in day -9 and -8 and -7 to be reflective of those changes in risk factors, then we're going to learn way more about, well, we can learn more about the product, we can learn more about the places, we can learn more about promotion, we can learn way more about the price that are going to change, the prices that are going to be reflective going forward of those dynamic historical changes. So that pseudo kind of a historical simulation will allow us to capture much better the true risk of those deep out of the money put options in this example here, which means that we can price them better, of course, which means that we are in a better position to sell them, and then we can kind of promote them, et cetera, et cetera. Now, how about this concept of suitability? I always love telling this story of when I took my students to New York City. This is 100 years ago. It was the first time, and we met with a swap dealer for a large bank, and this swap dealer was really impressive. And she had just passed her level 2 CFA exam. And I had already gone through the program, so we were talking about that. And she was talking about her life. And she said, the biggest challenge for me is not trying to price a swap or, figure out, hedging and optimal hedge ratios and what's face values of the hedge instrument and all that kind of stuff. She said the biggest challenge was for her to figure out which clients were suitable for which types of swaps. And she said the only way that she could do this is just by visiting with the client. And so that's this core question there, the fit for purpose. So managing all of those active risks. And then, of course, all the swap dealers, and of course, here in the investment banking industry, we're worried about what the banking agencies tell us, and then we worry about those Basel requirements. Look down at that third arrow point. This is probably a good question in which the GARP would give you something like, hey, here's a model. We think it's a perfect model. What's the problem with having something that we think is a perfect model? And the answer is, of course, we can talk about standard deviation as a measure of total risk, but does standard deviation actually account for all of those risks that are material and that are relevant? And the answer is, we can do our best. And that's why we move from the profit and loss models to these more advanced and extensive and sophisticated value at risk models. Here's one of my favorite topics. I teach my students in almost every class about sensitivity analysis. So just think about, and you probably heard me say this before, just think about an Excel spreadsheet that has, time across the top, whatever it is, and then all the different variables down at the bottom, down on the left-hand column, and down at the bottom, you have some profit and loss measure, however you want to do it. And so what I tell my students is and some of my students are smart, they can write macros to go back and change some of these variables by just small amounts. But remember, what we're doing is we're going to go change one of those variables, and we do it in Excel. So a lot of times I'll just make up a number and say, oh, instead of 100, suppose it's 110. This is how sophisticated we get in some of my introductory classes. But of course, in sensitivity analysis, what you're doing is that for each one of these input variables, you have the entire distribution. And so you just tell Excel to reach into that distribution and pull out a value and throw it in there. And then you recompute profit at loss at the bottom, or value at risk, or whatever it is that you want to put down as your output. And so we're changing these positions by small amounts. My students will always ask the question, Jim, you don't look like these are not big changes. Why don't we double it or triple it? And I'm like, well, you know what? We can do that, but when you do that, you're going to get an answer down here that may or may not be realistic. So think about the sensitivity analysis going back with the pseudo-history. When we go back to day -10 to -9, we could say, all right, the value at risk was 10 during that period, whatever it was, and the next day it changed to 9 or it changed to 11 or some number. And then you can go and change all of those positions based on what you knew that happened of those risk factors. And you can compute that output, which is profit or loss or value at risk. What this does then is it allows you, and I tell my students this, I say, essentially what we're doing in class is we're making up all these numbers. But here, when you're using this pseudo-history and historical simulation, you're actually dipping into a distribution that is reasonable. Let's go back to that soundness thing that we did in that very first slide. Is the distribution reasonable? Does it contribute to the soundness, or is it is it some kind of crazy Jim's distribution out there that doesn't make any sense? So the cool thing about this is that what we're doing in this Excel spreadsheet. Now, of course, when you guys do this, it's much more sophisticated than an Excel spreadsheet. You get some output value at risk. And it reduces the omissions in the model, and it reduces the complexifications because you have this one value at risk at the end. Look at the focus on that third bullet point there. It identifies which factors or positions drive that value at risk or standard deviation or profit or loss, whatever you want to do at the bottom. So what are the key steps here? I think I just worked through those. Identify those key inputs and vary them by small amounts, and then observe those changes in the outputs. So let's do some just quick example here. So we've got equity options. We want to assess how changes in volatility assumptions affect its value at risk. So think about a spreadsheet, and you have standard deviation over here or some measure of volatility. How are you going to do that? Do you want to use implied volatility? Do you want to use a Garch model? Do you want to use Jim's standard deviation estimate? Well, we got to come up with these sound and reasonable assumptions. What we want to do is we want to compute a whole bunch, maybe hundreds, if not thousands, of value at value at risks to see exactly what that risk factor of implied volatility, how that contributes. Now, of course, we know tons about call options and put options. We had great conversations about that back in part 1. And you guys, congratulations for passing part 1. So remember to retain all of that knowledge base so that you can apply it here. I mean, it might be that, well, let's suppose we hold a portfolio of equity options for stocks that have low standard deviations. Well, maybe, just maybe, that volatility doesn't contribute much to value at risk, as opposed to stocks that have high betas and high standard deviations. And so they have a different set of equity options. Man, look at the last teardrop point we have under different volatility scenarios, and that could be almost anything. Remember that that GARP has tested you guys back in part 1 about the financial crisis, so it's reasonable for here in part 2 for GARP to say something like, hey, let's go back to pick a month in early 2008 and say, okay, we're still back in a normal economy. What happens if volatility explodes because of the financial crisis or COVID or whatever else that thing can be? So keep in mind that whatever showed up back in part one is a reasonable, maybe not a direct question, but some underlying assumption for questions that you guys have to think about. All right, get more detail here about this example. 100 out of the monies, 50 at the monies, and 20 out of the money put options. So we've got shorts and longs, et cetera, et cetera. So what's the key input? What is this key risk factor? So implied volatility. We also need to worry about the correlation between and among all of the underlying stocks. We've got stock A, stock B, and stock C. So think about this. If A and B and C, if the correlation coefficients between and among those three is exactly 1.0, well, that's going to have some kind of impact on the performance of our portfolio from, of course, a profit and loss standpoint, but more importantly then a value at risk standpoint. And then we know everything there is to know about the binomial model and the Black-Scholes-Merton option pricing model from part one. So you know you need a risk-free rate of interest and a time to maturity. I want to say something about time to maturity here in the context of this example and a potential exam question. Remember that, and this is obvious, longer term options have higher prices because, you have a greater time period for which the option to end up in the money among other reasons. So don't be fooled. Don't be tempted to ignore and focus on, the obvious risk factor of implied volatility. Don't lose track of some of those other inputs. So look down at the bottom. Suppose we've got 20 and 25 and 30% for those implied volatilities. And there's a $5 million value at risk at the 99%. And by the way, the very first sentence or so in this chapter reminds us that way back in 1996, the Basel Committee established that 99% confidence level. So let's go ahead and increase or decrease by 10%. So there you go, scenario 1 and scenario 2. So this is super simple. I mean, we could do this in Excel here and just have one change in that implied volatility. And then at the bottom, we're going to recompute the price. What do we have back here? So we're going to recompute the price of those the calls and the puts, and then at the bottom, then we can have some equation to compute value at risk. And so we'll have a bunch of those value at risk at the bottom of our Excel spreadsheet so that we can determine what those value at risks are and how they change and how sensitive they are. Remember, we have that, the volatility smile and the volatility kink and the volatility frown. Is there one of those things out there? So this might be a contribution. And that's why I was saying here, we don't really know what the time to expiration is on these three positions, but maybe the 200 longs, maybe they're a week, maybe the 100 shorts, maybe they're 5 years, so we need to make sure that we're sensitive. Now, in this example, all we're doing is changing the implied volatility, but you can imagine where we put together a spreadsheet where we change the implied volatility. We do that a bunch of times. Then we change the risk-free rate. We do that a bunch of times. Then we change the expiration date, then we recompute value at risk a bunch of times. Then we can change exercise prices. We can throw in all sorts of things for the stock price. We could throw in economic risk, systematic risk, and unsystematic risk. I mean, think about how complex this is. And sooner or later, you get an Excel spreadsheet that is unwieldy, which is why there's software out there to do all this stuff. Boy, I sure hope I don't have to go over these potential benefits for you after that example. It identifies those key drivers, assesses the robustness. It quantifies all of the omissions because you can see, suppose that you put in a 0 for the risk-free rate of interest and recompute it over time. That would be an omission, or 0% volatility, although I don't know why you would do something like that. But anyway, you get the point about the relationship between the dynamic changes and the possibility of omitting some essential key risk drivers. What are some things that are challenges? Well, you got this big thing, and you're basing it on some original data set. Maybe we have limitations, but that's when you can bring in that historical simulation that we talked about initially. There we go. Computational complexity, too complex for the Excel spreadsheet. If you use proxies, you may use those proxies with an error, so you bring in inaccuracies. Result interpretation, careful differentiation between statistical and economic significance. I'll tell you just a quick story. When I was defending my dissertation, part of my dissertation was on poison pills. You guys learned about poison pills back in part 1. And one of my, so there's a whole bunch of professors in there, and I'm so nervous, and I'm just hoping these professors don't ask me a question that I can't answer. And so there's one of my fellow PhD students, and one of these dudes, he raised his hand and he goes, Jim, I see you have some statistical significance here. What is the practical or the economic significance? And I wanted to say, dude, someday you're going to defend your dissertation, and I'm coming and I'm going to ask some silly question. So it wasn't a silly question, but it put me under a lot of pressure. And I probably answered it okay, but make sure that just because you come up with a statistically significant, whatever the output variable is, that you can provide some kind of foundational financial or economic research or idea or theory that's going to support it. You don't want to have something that's statistically significant and then it has no meaning. All right, how about the challenges when calculating confidence intervals? Let me go back to what I said initially, that this author says, you know what, I'm not quite sure why, but very few of these bank holding companies go ahead and compute confidence intervals for value at risk. Well, just remember our simple example for value at risk. You take the mean plus or minus, some kind of a critical value that you get from the tables, and you multiply that by a standard error. So in value at risk, the true challenge is to come up with what is a reasonable standard error for a 10-day window for, let's just go back to that portfolio. What did we have? A whole bunch of calls and, two parts, two different put options. So we've got this portfolio. What is the standard error for derivative securities? So there we go. Quantify the estimation risk. That's the big problem right there. And it relies on these estimates that we're making. Think about these estimates at the bottom of our Excel spreadsheet. So suppose that we have a value at risk of 10 million. There's the confidence interval. We got 9 on the bottom side, 11 on the top side. So how do we calculate these things? Well, a couple of different ways. Let's go ahead and talk about 3 ways to calculate these confidence intervals. And remember what I just said a moment ago about the standard error. So the first way is to use this asymptotic standard error approach. So we're going to go back to the PDF and we're going to reach in and extract from that PDF some estimate of the standard error. We're going to do this for large data sets, especially when the returns follow a known distribution. Remember that word asymptotic means that we're approaching some kind of a limit. A lot of times in calculus we approach infinity, but we never quite get there. That's why we say the large data sets. But in probably this case, we're going to approach some kind of a limit. I mean, if we have a $100 million portfolio, we can't have a $1 billion value at risk. What we can do is take a look at a non-parametric approach. We can just go ahead. Well, this is what we did back in part 1. Remember when we hit our value at risk, and then we were worried about, and the examples back in part 1 were mostly 5%, 95% value at risk. So what did we do? And that 5%, we kind of chopped them into their components, maybe 5 or maybe 10 or maybe 20. And then we ordered them. And remember, we did all this to compute the expected shortfall. Well, this is the order statistics here. So look at the steps. You do the returns from worst to best, you identify that value at risk, and then you can extend it back into expected shortfall, or you can just take the difference between those ordered returns, and those ordered returns are based on a confidence level. Then you can do the bootstrapping, which goes back to the historical data set and reaches back in, takes something out with replacement. Remember, bootstrapping with replacement to generate multiple value at risk estimates. So there we go. There are the steps. We draw the random samples, calculate it for each sample, and then you have that you have that distribution, and then you can do whatever you want there, 2.5% to 97.5%, or a 0.5% to 99.5%. I mean, however you want to work it. And there you get the confidence interval. So these are three, acceptable ways to compute value at risk. We've talked about these in the past. The next part of the learning objective asks for the challenges. And of course, if we assume normal distribution, then we're ignoring skewness and we're ignoring heavy tails. We also have to worry about volatility clustering. We also have to worry about that breakdown in correlation, so that if we have this portfolio and we have some kind of a bad news, and then all of our financial securities, they crash together, that's kind of part of volatility clustering. Data limitations, we talk about this all the time. If we have a time series, we did this back in part 1. Remember, we have to worry about things like serial correlation, autocorrelation. We need to worry about error terms being IID. And if we have a time series, remember we did the random variable test. We did all those fun tests with the eigenvalues and the eigenvectors. Anyway, so you always have to worry about that inside of a data set. And by the way, you should remember from part 1 that there are tests. There are tests for heteroscedasticity. There are tests for multicollinearity. There are tests for autocorrelation. And then there are ways to correct for them. That's not a part of this. That's not a part of this learning objective or this chapter. But you were tested on that. I know that. I know you were tested on that back in part 1. And then granularity of results. This seems to be one of those cool words that I have learned to use over the last, 5 or 10 years. Just think about grains of sand on a beach as components of the portfolio. And so the temptation is to, dig down and dig down and dig down till you get to that one final grain of sand. The question is, how do you find that grain of sand? Look at the bottom example. We might struggle to provide robust confidence intervals or confidence bounds. And that's why in a later chapter inside of this topic, we're going to go ahead and talk about principal component analysis. So this is kind of the opposite here, granularity and principal component. Do we want granularity or do we not want it? That's a tough one. How about benchmarking? Now, you guys have heard me say this many, many times before that, ideally the benchmark is going to consist of securities and positions and risk factors that look exactly like the portfolio, but they're completely different securities. Similar securities that have similar risk factors and exposures, and so you can just compare them. What we're doing here in this case, specific to value at risk, is we're looking at our value at risk outputs based on all the stuff that we've talked about, like sensitivity analysis and using the Garch model, et cetera, with some alternative model. Once again, this guy from the Fed says, you know what, benchmarking is not used as much as he would like it to be. In fact, there's a sentence in there that says something like, you know what, once the bank holding company puts together its value at risk model to satisfy, whatever those Basel requirements are, it has a little bit of downtime, and so it should use that downtime to build up a good benchmark. Yeah, why benchmarking matters, of course, regulations, risk management, model improvements. That's okay. I love that model improvements motivation, because if you're looking at your portfolio and you're looking at the performance of the benchmark portfolio, I mean, you'd have to be a slug not to learn something from that benchmark portfolio, which then has implications for improving the model. Now, some challenges here to benchmarking. Don't you love those two graphs over there? There's a graph of the errors, maybe in a regression or maybe in some other type of a model in which they are independently and identically distributed. My professors in graduate school, I mean, they talked about IID every second of the day, no matter what topic we were talking about. And so then the importance is, when do we have violations of those independent and identically distributed error terms? And there's that second thing, you go out like this, and so it's kind of like anarchy. So the problem then is, if you have anarchy in the non-IID graph, then all of those value at risks are probably going to be incorrect, because the difference between what you predict and what you actually see is going to be a tremendous difference, which means that forecasting goes right out the window. Now, what did I say earlier? We need to create this benchmark, but there's not a lot of models out there that are going to help us in terms of coming up with that significant multiple value at risk model that brings up into all of our expertise in terms of the assumptions and the soundness that we talked about at the very beginning. Then we need to worry about this conservatism, because what Basel people will do is they will say something like, if you have this much value at risk, let's just pick a number here, and then the confidence interval looks like this. Well, what we want to do is we want to go ahead and extend that out. We want to extend the value at risk to a little bit higher number, and we want that confidence interval to be a little bit wider. So what does this mean? The idea is to promote stability in the financial services and the commercial and the investment banking industry. So, of course, the regulators are going to say something like, that's your internal model. It might be accurate, but let's go ahead and be on the safe side. What was that term that we learned during COVID? Out of an abundance of caution. Well, that's probably what can be applied here. Let's take a look at an example here. We've got an internal model, 15 million, but the regulatory people tell us 25 million. So there we go. There's the problem with conservatism. So how do we come up with a benchmark model? Are we going to come up with a benchmark model that's related to there it is in orange, our $15 million portfolio value at risk that reflects our portfolio? Or do we want to go ahead and be consistent with what the regulatory agencies tell us? So the problem then is that this benchmark may or may not be reflective of the actual risk and the risk factors of our portfolio. So how do we overcome this? Well, we can do these loss function based comparisons. To go back to what you remind yourself about from part 1, we did a whole bunch of different loss functions there. So what we're going to do is say, let's go ahead and just pretend that we're going to lose, pick a number, 10 million. And then let's go ahead and compute some value at risk based on differences between that predefined loss. What did I say? 10 million. But we have to have an entire function, an entire distribution. So that loss function and the differences between and among the different kinds of loss functions, well, they may overcome those. Let me go back here real quick. They may overcome those benchmarking challenges. It addresses those non-IID errors, balances conservatism. Remember that conservatism versus accuracy, that's like a marginal cost, marginal benefit. Now we can do a statistical test, just this super simple sign test. That's just the difference between the performance of these two models in terms of computing two value at risks over time. Are they positive or are they negative? How does this work? Well, it's going to specifically address that model conservatism, because if you have the same sign over a 10-day window, then you can say, you know what, we have this problem of conservatism, and then we can go ahead and correct for it. We can use just a simple old P&L model that we learned back in the very first chapter in here. We can use GARCH, we can use real world data, compare that to the internal value at risk model. So this P&L just gives us another benchmarking as an alternative model. Of course, as the P&L historical, it captures those actual market behaviors. And that takes us through those 4 learning objectives. What I want you to do now is go back to our portal and take a look at the handful of questions that we have come up with here. You'll note that those are pretty broad and pretty deep, so this is a good coverage of those questions. So hey, I appreciate you spending time with me today. Enjoy the rest of your day, and good luck studying.